Hey there, welcome to the channel. So today I want to bitch and complain a little bit about some people that think that you can have something for nothing. All right, so I was listening to some videos today and there's people complaining about the $40 billion bill, this bill that's being passed or going to be passed that's sending $40 billion to Ukraine. And well, I definitely concur with criticism of that. It's a massive amount of money that's most likely most of it's going to get stolen or whatever. Who knows what's going to happen? Well, I concur with that. Some of the comments are from some of the commenters are like, "Hey, what we learned from the financial crisis is that you can print money anytime you want." And this is something that this lady had said. And she said, well, what we learned is you can print money anytime you want. So what's the big deal? So she's complaining about with respect to the baby formula problem, which I get is a big problem and it's an annoying problem. Um, and so I get that. But it does reveal this statement that we can print money anytime we want. We just have to choose to do it. This is a really bad way of thinking about things, and it's incorrect. There is always a cost to everything that we do. Nothing is for free. There is always a consequence. And right now, we are at a situation where we have very high inflation. And as a result, the Fed is raising interest rates. Now, the Fed, of course, is the cause of the inflation because the Fed prints the money, then they print too much money, and the inflation pops up, and then so basically they're the arsonist that sets the fire, and then they come in as the fire department to put out the fire. It's like it's crazy, but it's very important to stop thinking that we can just do whatever we want without consequence. So if we look at that, we're going to go to the Fed database. We can look at two things, and we're going to put these two charts up. We have the M2 and the Consumer Price Index. Note there's a factor there, and the factor is just kind of basically scaling because CPI is in different scale than M2. But you can clearly see in this chart, going back into the 50s and 60s, you can see that as the M2 money supply in blue has been going up consistently. And this represents, a devaluing of the dollar. But what you can see here is what's happened recently. And this is an important line over here. In 2020, we had the shutdown for the cerveza sickness. So right over here, you can see that at that point, M2 money supply skyrocketed. And what happened in a very short time is they increased the M2 money supply by 25 to 30% in one single year. And notice that they continued to increase the money supply. But notice what happened, what also is happening at that time. What's happening is the inflation, the CPI, the brown line is also going up. So the brown line's going up, the M2 is going up, but they're going up at maybe a 45-degree angle. But you see, once that after they started printing money like crazy, the M2 is going, like you'd call it hyperbolic or geometric or whatever. It's going through the roof. And at the same time, it's causing the CPI to go through the roof. So this is chart proof that you can't just print money. You just can't print money without consequence. At some point and at some time, that money has to go somewhere. And there's certain key differences about what happened this time in 2020 versus what happened in the financial crisis. So if you go back to the financial crisis, what happened was basically we had a huge housing bubble, and it was spurred on by a combination of, government wanting to basically encourage home ownership, in addition with kind of corrupt banking where they were basically making loans to people that should not have loans. The result was that we had a situation where we had all these people bought homes that they couldn't afford, that they never could afford. They bought them on sketchy loan terms such as that were all adjustable, meaning that if rates went up, the amount of money you were paying for that housing payment would go up. So they had these like 3-1 arms or 1 2 arms or 3 5 arms. And what these things would do is, like, for example, it'd be fixed for 3 years. And then after 3 years, it would become variable. In addition, many of these loans had situations where they had basically balloon payments, and they had something like after 3 years or 5 years, the rates would skyrocket, and basically the payments would double or triple. And so basically the person could barely qualify for the loan in the first place. And when that happens, when their rates went up, they just couldn't pay for the house. So basically the house, basically has to go into foreclosure. Then what would happen is all that paper, all that debt was bundled up by Wall Street into mortgage-backed securities, and then to CDOs built on mortgage-backed securities, this paper. So all these investors, basically this spread across the world. All this paper became worthless. All these mortgages were defaulted on. And basically you had this big financial crisis, and it caused all these different hedge funds and everything to go belly up. And the reason that all happened was because why? Because, hey, they basically had bought all these mortgages and stuff like that. And these mortgages all defaulted. And so what happened was, in the financial crisis, the government bailed out all these big firms. Now, one of the worst ones was Goldman Sachs got $13 billion from the AIG bailout, because AIG was their insurance company, but they were writing insurance on mortgage bonds, credit default swaps. Well, they didn't have the money to back up those credit default swaps if the mortgage is actually defaulted. So what happened? Well, of course, what happened? Basically all these mortgages went belly up, and they didn't have the money to pay. In particular, in this case, it was like Goldman Sachs was out $13 billion. So as part of the bailout, Goldman Sachs got the $13 billion. So what happened is, the difference though is, at that time, and I'm not justifying it, I 100% disagree. Goldman Sachs actually probably wouldn't have gone bankrupt, but they should not have been bailed out in that way. They took the risk. They as well knew the risk they were taking, and they shouldn't have been bailed out. However, one thing to note is, when they printed all that money, that it went to plug the holes in the balance sheet. So when you gave Goldman Sachs $13 billion, Goldman Sachs didn't go take the $13 billion and go spending it on Twinkies and at the grocery store and on gas. They didn't do that. It just basically disappeared into plugging up a hole in a balance sheet. So what happened is, after that, you did not get inflation. Now compare that to what happened when we shut down for the cerveza sickness. Well, what happened? We basically gave stimmy checks to people. We gave billions and billions of dollars of money to people that were going to spend it in the real economy. So therefore, you had people not working because everything was shut down. At the same time, they had all this money to spend. So you had increased demand for stuff at the same time that you had less stuff because people weren't working. And so basically this all contributed to inflation. But the point is, there's always a consequence. When the government and the Fed, they go and they print money, at some point, that money is going to find its way somewhere. And what you will see is, actually, in the first part of this crisis, when you look at that chart, you see that the stock market went through the roof. So that was the first part of the inflation. All that money went in there. A bunch of that money went into cryptos. It went into the stock market, went into the bond market. So this all looked really good. And this is very common from what happens when you have a great inflation. So the inflation happened after 2020. They gave everyone stimmies. They printed all this money. The stock market goes to the moon, goes to new highs, and all this stuff happens. But what you have to understand, so the good part of it was the asset prices go up. But remember, at the same time, that all these people had all this money to spend on stuff. And where did it go? Well, eventually that shows up in real things that people need to buy. So fast forward, you have 5, 6, 7, 8% inflation now, because all of a sudden it's not that the cost of those things went up. It's that the value of the money you're using to buy them went down. Think about it. It's very simple. If you take a game, let's take Monopoly, and everything you're dealing with hundreds and then maybe thousands of dollars. Well, if you take that game and you just said, instead of going around, when you go around go, when you get that $200, and that's kind of the money that the players get to use. So they get $200 every time they're around the board, and then they can invest that, et cetera, in housing. And that's kind of the key of the game. Well, if you give them $2 million, then all of a sudden they all have all the money in the world and they just go bid things up. But of course, what happens is the price of Boardwalk wouldn't be $400. It would immediately go up to $4 million or $50 million. And so that's what happens. It's the money is being devalued. So really, that's why what is so dangerous about this trend towards modern monetary theory. There's this view in this MMT world that, hey, look, the government can make decisions to spend all the money they want, and they can just print the money and there's no consequence for it. And they do exactly what this commentator was doing in terms of they look at the financial crisis and they say, hey, when you go back to the financial crisis, hey, we printed however many $1 trillion. And there was no inflation. So we could do that anytime we want. But the answer is no, you can't do that, because you can't print $2 trillion and give it to real people that are going to spend it. Because if you do that, the cost of things will just skyrocket. And that's exactly what we're seeing. And now, if you don't believe me and you disagree, okay, I understand. But understand what's happening. The Fed right now is cranking rates up. They cranked up by 50 basis points, and they're talking about multiple 50 basis point increases. Why are they doing that? They're doing that. They know that they need to kill that demand, because that demand is still there, right? Even though now the economy is rolling over very fast, housing is rolling, everything's like falling off a cliff very fast. There's still a lot of demand there because there's still some money, there's still credit there. And so what are they doing? They know that they have to cause a recession. They have to get the demand down. And that's the only way to cure the high prices. You have to get the demand down, because the thing is, it's already too late. They printed the money. You can't take the money back. They can't go and say, hey, we're going to go to every person and we're going to ask them for $2,000 in money back. You can't do it. They don't have the money. I don't have the money. No one has the money, right? So that's not what they can do. So what they have to do is they have to kill off demand. And what that means is they have to crank interest rates up, which is going to make everything that requires borrowing money more expensive. So therefore, cars, homes, all that, they're basically crashing those markets right now. They're killing demand. You had car prices go up a lot. You had used car prices go up a lot, and that's starting to ebb and flow a little bit because it's so unsustainable. But they're going to get that down. They're gonna knock that off right there, because if they make the cost of money go up, which is what they're doing, they can kill off basically they're going to kill off the demand for cars, kill off the demand for housing, and all the residual stuff that comes from that. That's literally what they're doing. So the Fed knows this perfectly well. So there's some people like Lael Brainard and stuff that are MMT people on the Fed, in the Fed circles. But overall, the Fed, they understand this. They know this. They know that MMT will never work, because if you just print all the money you want and give it to people, you will just have skyrocketing inflation. Now, you could go and say that, hey, well, if we have something we need to do, the government can print money at any time. And well, if there's inflation, there's inflation. But you have to understand you're always behind the curve with that inflation, right? So here's the thing. You're making minimum wage. And now minimum wage has gone up to $15. A lot of places are paying like $20. Okay, but at the same time, the price of the things you need to buy, gas going from $3, $4 to $6, $7, the price of the things you need to buy has gone up faster than your wages have gone up, faster than the minimum wage, faster than they can send you stimulus checks. That is inherent in the system. And that is why many times throughout history in the US anyways, going back to the 70s, going back to the 80s, Volcker went and killed inflation by just cranking rates to 18, 20%. Why did he do that? Just to kill the inflation. Now, in this case, what's going on here? Are they going to go that high? No. I think that we're in a little bit different situation. And the issue is that we had quantitative easing, which was not going on back in the 70s. And because of quantitative easing, where the government basically prints money to buy bonds, so they basically finance the debt, because they cut back on that and they're selling off the bonds that they had bought, they're putting those into the market. Because they're doing that, in essence, if they go, it may be, there's some conversion factor. So it may be that if they take rates to 3% on the Fed funds rate, 4%, that might be the equivalent of like 10%, given the fact that if you factor in the amount of that they've stopped their purchases of mortgage-backed securities, stopped their purchases of treasury bonds. See, and that's what's happening in the market. When you look at it, it's like, well, why has interest rates gone up so fast and faster than the Fed? Well, part of that reason, I believe, from just looking at the charts, is that what you're seeing that the Fed demand from the Fed pulling away. And so there's one less bidder with infinite and deep pockets that is not out there buying up these bonds, buying these up. And matter of fact, now they're starting to sell some of them. And so they're actually putting more demand out there. The more supply, the lower the price has to go. Simple supply and demand curve basics. So in conclusion, it's a bigger picture. It's a bigger picture of life. And it seems to me very like, at least in the political discussion, in the discussion of casual discussion, and definitely in politics, there's this view that, we just have to have the will to do it. We can do whatever we want. There's nothing stopping us. And, if we want the Green New Deal, all we have to do is print the $100 trillion to do it. But everything that we've seen in the last 2 years shows us that you can't do that. You can't do that. If you print $1 trillion, $2 trillion, $3 trillion for a Green New Deal, you are going to have inflation that's going to go hyperbolic. You're going to get 10, 20, 30% inflation. And then no one's rich. No one's better off. The only people that are better off are the rich. In a way, you're helping the rich, because think about what has happened in this whole time. This whole time, who did you help? If you're a working class person and you didn't have any money left over to put in the stock market, have you benefited since the cerveza sickness started? No, you didn't get the benefit that the fact that the stock market went up 100%. You didn't get any benefit. Who got the benefit? All the rich people that just have nothing to do with their money and they just put it in there. So when you have a situation, we have like the Bernies and the AOCs, and they want the monetary MMT, and they want to just like the government needs to grow and spend and just take care of all this stuff. And you're buying that story. I believe, like with AOC, I don't know what her intentions are. I don't really think she has any good intentions. But with the Bernie, I do. And maybe I'm a sucker. Maybe I'm a sucker for an old Vermont kind of guy. But yeah, I think he's really genuine. But you have to, and I think he's got good intentions. But you have to, intentions almost don't matter in the real world. They really don't, because if we gave Bernie everything you want and you just print an extra 2-3 trillion a year, all the people that I believe he really wants to help are not going to get help. They're going to get killed by the inflation. And then the Fed is trying to kill that inflation off. Well, how are they doing it? Well, you're losing your job. That's how they're doing it. Don't you understand? At the end of the day, when they make the cost of the cars, homes, everything that you buy more expensive, they're cutting the demand for it. The demand will cause all those companies that are related in supplying that to lay off. So in conclusion, there is no free lunch. We can improve all these things and we can make things much better, but we can't just willy-nilly print money. We have to invest money in the right places. There should be very little handouts and free. Anything that you're investing is, you need to get something back. You need to be teaching people to fish, helping people fish better. Those kind of investments. Now, why are those not as inflationary as just giving people money? The reason they're not as inflationary, because you help a person get up and get a better job, get more skills. They make more, but they only make more in a market society. They make more because they're producing more. And that producing more keeps prices lower. Like, look at the tech companies. The tech companies, the history of tech with the S curve and everything is always all these things. Like back in the day, an iPad or a VCR cost so much money. And then the goal of those companies was deflationary. They wanted to cut that price down because they knew, like, look, if I only sell 1 million of these things, I'm going to make diddly. But if I can sell 1 billion of them at 1/4 the cost, I'm going to make so much more money. They really want to do that. And they can do that only if they can successfully, the people that they hire and the designs and the way they do things make it possible to do it cheaper. And if you do that, and if people have the skills that employers need, then they can pay them more. And it's not inflationary because that employee is bringing that extra value. The cost of those things are deflationary to counter the inflationary of the salary. And if you have more of that in the macro sense, you will have a much better society. That's it for this one. Bye.